Welcome to the Four Cornerstones of Corporate Finance. This is based on a book written by McKinsey and Company. I recommend you get the book if you can. It's very good, and what it does, it spells out a framework that you can apply to a business in order to create real value. This is not about accounting gimmicks or financial engineering or phony metrics. Okay, these are real ways to create value within a company. And what typically happens when you don't create real value? You have market crashes. Here's some of the main ones that I know of. The first one was in 1637, the tulip mania bubble. We had the Wall Street crash in 1929, the technology bubble in 2000 that most of us remember, and the financial crisis, which I think everybody remembers, in 2007. If you look at an individual decline for some of these market declines over a period of years, the largest was in 1929, which was an 80% decline in stock values, and the lowest was in 1946, which was a 20% stock value decline. And the reason for these declines is really because people were buying stocks that didn't have real value. If you look at an individual decline for stocks in the stock market, here's some declines we have here of 21% in 1946, and in 2007 it was a 50% decline in one day. And the reason for these declines is because there's not real value in a lot of these underlying companies that people bought. They went down because increase in margins, or high PE ratios, or high inflation, or speculation, financial issues. Okay, these caused declines because people didn't really have real value. Now, if you look at McKinsey's four cornerstones and to understand how these work, I'm going to apply it to GE stock. And the reason I'm going to do this, because obviously GE is a very good company, or was a good company. It's been around for 100 years. It has lots of access to capital, the best and brightest managers, etc. Yet, this company lost focus. And their stock went from $23 in 2013 down to $7 in 2018. This is a 70% decline. So let's take a look at how the four cornerstones of finance would be applied to this company. Now, the four cornerstones basically are the core of value, the conservation of value, expectation treadmill, and the best owners. Now, to break these down simply, core of value is financial ratios that really mean something, like return on invested capital or sales growth. Conservation of value is cash flow, right? I mean, what are you really buying when you buy something is cash flow. And the expectation treadmill, well, what do you expect to happen in the future? Companies don't trade on what they're doing now. They trade based on what they're going to do in the future. And the fourth one is my favorite, best owners, meaning that some people should own certain types of companies and some shouldn't, right? Now let's take a little bit deeper dive here. This is the first cornerstone, which is core of value. And the two key metrics they talk about in the book is return on invested capital and sales growth. And here I have a little chart that I made up from 2011 to 2018. You could see sales growth was not that great, under 5%. Return on invested capital was less. And stock price actually went down when these two plummeted, meaning that return on invested capital and sales growth are probably two very good metrics that you should use. And it's important to realize my favorite one is a return on invested capital. And the way I look at this is if someone is paying you $1,000 as an employee for a company per month, but it costs you $1,200 to commute there. And that's what return on invested capital tells you. If your return on invested capital is lower than the cost of capital, you're losing money. And this is a great metric to understand and use. Now, the second cornerstone is conservation of value. And a lot of this really does have to do with financial engineering. But the real way to get through that is to look at cash flows. Because cash flows can't be manipulated. And here we have cash flows for GE, which were $24 billion in 2009 and went down to negative $435 million. And expectation treadmill, I don't think this goldfish is going to make it, What do you expect the company's going to do? And this is going to be based on the cash flows and based on return on invested capital. And the last one is the best owners. You know, GE owns a digital software business, aviation. They should not have been owning those type of businesses. That's not what they're good at. They should have stuck to their knitting, which was what? Renewable power, right? That type of stuff. So those are the 4 cornerstones. Okay, basically, return on invested capital, know what it is. Know the cash flow for a company. Know what the expectations are. And make sure you're the best owner. Thanks for listening.